I know that most investors are constrained, but we go back to why do people keep trying to fish in the same overfished pond? All the evidence suggests that large cap US equities in particular are pretty darn efficient. It's a very hard market to beat, especially in a public mutual fund or an ETF. You can unshackle your risk budget from this long only concept. And just say, let me just get the beta and let me stack something else. What do we have more confidence in generating positive excess returns on a more consistent basis than stock picking? And I think there's a whole lot of things that I would rather spend my active risk budget on.
Yeah. If you care about beating the index, you can try as hard as you can competing for that money against other stock pickers, or you can simply just think about macro inefficiencies and use that to your advantage. And I don't think anybody's using that to their advantage. Hello, everybody, and welcome to the first and inaugural episode of the Return Stacking podcast. This is something that we're going to hopefully try to do once a month going forward, where we're going to talk about all things return stacking, the different elements that one could use in the return stacking space, and how they're interacting with the markets today, and the individual players, how they feel about it. So we're going to try to expound on as much as we can every month on what we've learned, conversations we've had, and maybe some of the pieces that we've written on the Return Stack .com website. So with that, today I am joined by Corey Hoffstein, CIO of Newfound Research. We have Michael Philbrick, CEO. We also have Adam Butler, CIO, and myself, President of Resolve Asset Management Global. I think there's plenty to talk about. Corey, you were saying that there's some interesting discussions being had in the investment space with regards to return stacking, especially the transition of how people felt in 2022 versus 2023 and now 2024. Why don't you tell us a little bit of the conversations you've been having?
When we co-authored the paper back in 2021, the original return stacking paper, a lot of what we were focused on with the return stacking concept was how do we introduce alternatives as a diversifier while allowing people to keep their core stocks and bonds that they wanted, allowing these diversifiers to be in the portfolio from a structural perspective, hopefully allowing people to make them more sustainable so that when they needed them, they were actually there rather than doing this performance chasing that's all too evident in the space. 2022 then rolls around, and I don't think in any of our careers, we have had a better timed paper for precisely what we were talking about. But 2022 seems to be squarely out of the rearview mirror. We're well past that at this point. 2023 was such a strong market. I think we have bullish fever at the moment that the conversation for me with a lot of the return stacking ideas has gone from how do I use return stacking to plug the risk holes in my portfolio to how do I use return stacking to create excess returns I have higher confidence in versus security selection. And what's funny is it can be the exact same thing, right? You could just stack, for example, managed futures on top, and it's the answer to both. But the shape of the conversation, what people are looking for has drastically changed.
It's just been so funny because I've noticed that the conversations in 2022 were about how do I use return stacking, or at least there were significantly more conversations about how do I use return stacking to create an all-weather, all-terrain portfolio, right? Where I actually don't want any equity risk or bond risk. I want to manage that with whatever stacks we can do. To, yeah, no, that thing, I don't care about that anymore. How do we get the S&P 500 plus? Or like
Yeah.
80-20 plus or 60-40 plus? Less 60-40, more 80-20. A lot of S&P 500 plus conversations.
I think
So
people, what they want right now is for us to stack Bitcoin on ETH on NVIDIA. If we could
On
deliver that,
NVIDIA gold.
I'd get
Yes.
billion.
I'm a yes there. When do you want to do it?
but it's true. It's just amazing to see the animal spirits shift around.
I think the conversations I've had anyway have centered around the fact that while things are expensive, they're not as expensive as they've ever been in the US, certainly not as expensive as they got in Japan. And the ferocity of the FOMO as you climb that curve intensifies dramatically. And I think we're seeing part of that, but it's possible that we haven't seen anything yet, and that this right tail risk is truly the potential issue as advisors who are trying to take a more sort of risk averse course, I'll call it, maybe adopting more tracking error. are going to feel more pain, lots more pain. And trying to hedge that potential outcome and understanding history and a little bit of market history is, you get the best of both worlds when you're return stacking, because you do have your diversifiers in there, and hopefully they will fire at some point to offset some of the potential drawdowns happening in the betas.
Well,
But you are participating all along the way. Go ahead.
that's the other thing that has popped up in our conversations in the last 12 months is that you see big exposures in the markets in the S&P 500 to the 5 stocks that have moved it. And very few advisors are fully exposed to those things because they're smart. They're being prudent. And a lot of them are sitting in a lot of cash and we're sitting in cash throughout the second half of 2022 and throughout 2023. And so I think that FOMO, not just from the advisors themselves, but I think the clients clamoring for, how did we miss this? It's an interesting use case, but we should do an analysis of what does better, a 30% cash buffer or an uncorrelated stack for the outcome of the ultimate investor.
Yeah.
Yeah.
You pointed out that most people don't actually even have the market weight to the Magnificent Seven. And I think what people don't realize is when the market becomes so top weighted, and I'm not making an argument here as to whether that's right or wrong or whether it's a bubble or not. But when it becomes so top weighted, it is very difficult for long only managers to have active bets without underweighting those top names. Right. So think about what happens if a manager is bullish those top names, and those top names are already 30% of the S&P. Now they're going to have 50% of their portfolio in those 7 names. That's a lot of career risk. But if you just market weight them, if you want to be neutral to those names, that eats up 30% of your portfolio as an active manager. Right. And so the reality is many of these active stock picking managers, because they don't have the ability to short by being long only, end up having to underweight those names to free up capital to put in names that they like. And so a lot of people just end up not even having market weight just by the constraints of long only. And so you end up underweight these names and chasing returns.
We were talking to Jack Shannon at Morningstar about this, about diversified versus non-diversified funds and the 75, 5, 10 rule, where if you're not tracking the index, you can't actually get there with the large holdings in the top 7 holdings. You can't track it. There's a structural impediment for active managers to actually achieve even getting an overweight bet on the things that are working the most, if you will.
That's a really good point, Mike. And I bet most people who are listening aren't even aware of those rules, that there are constraints as to how much a manager can actually put in a single name.
Let alone overweight them from whatever the index has them. Like how many active managers are getting the massive natural overweight that exists in the index already and saying, let's add 5% more to that. Just no, you're taking the other side for sure.
Thing that we also talked about is just how large and confident a view you must have on the sustained outperformance of those names in order to hold them in such high concentration in a portfolio, right? If you're an active manager and you're charged with having active views on a portfolio, right? Anytime you take an active view, it's a trade-off between, is the excess return I'm hoping to get going to overcome the excess risk that I'm taking? And so that's what sort of prevents diversified portfolios from becoming too overly concentrated. The magnitude of difference in expected returns between the Mag 7 and all of the other stocks, given their concentration in the index, there's no conceivable way that an active manager could possibly be that confident in order to make that level of active bet. The passive market is making a bet on those stocks that no reasonable active manager could ever take.
Yeah. Indexing continues to show time and time again.
Hit me, Corey. Hit me. I see you're grinding on that one.
I'm thinking through what you're saying. And I'm not sure I 100% agree with it, but it might just be that I'm not fully grasping what you're saying. I think if you said, all right, here's the 500 names in the S&P 500 and you know nothing about them to build up that confidence. But if you were to fundamentally weight them right now based on a mix of things like cash flow and revenue and a number of other fundamental measures, many of those Mag 7 will still be near the same relative proportion, right? So this, like, the question is, yes, they have a very large weight from a market cap perspective, but they also, relative to the other names in the S&P 500, have a very
Well,
outsized
keep in mind,
relative
I agree with that.
fundamental footprint.
That's a fair point. But it's not just about what that footprint is today, right? It's
Right.
also about what that footprint's going to be 5 years from now, 10 years from now. The market is supposed to be a discounting mechanism. Is the market expecting them to sustain this level of these levels of margins and this growth rate in sales ad infinitum?
Well, that's an
Because that's
interesting
what you're
point, 'cause
discounting them.
I
Yeah.
actually had this discussion seconds before this podcast with an advisor that asked, that basically said, look, the last 10 years of the 60/40, US 60/40, have been purely due to the fact that rates have gone down. And I said, no, it's been purely due to these handful of stocks taking monopolistic rents and the world thinking that they were just going to go up ad infinitum. And I don't know where I heard this argument, but with AI here, that we're looking at specifically talking about Google and how Google has made most of its profits on search. And with AI and the ability for like perplexity.ai and all the ability to just do it significantly cheaper, provide better results. Bard isn't, I don't remember if it's Bard right now or whatever name they have, Galaxy or whatever. It's just not catching up.
Gemini.
That the moat has finally been broken and those monopolistic rents are being attacked. Right. So you're right. If the market is a discounting mechanism and you have AI finally breaking the moats in a lot of these things, it might be time to share the love, and it might be the end of it.
What I do love is that people tuning into a podcast on return stacking definitely care about our views on individual stocks.
You
It's more of a
you gotta
view on
create some
portfolio
understanding of
management.
what could change the mandate so that they can add. I guess we're still trying to pitch diversification here when it doesn't really matter if you're just
I think I guess the point I would get at is it is very hard for a number of reasons to be an active manager. And Rod, you wrote about this, and the stat always amazes me. And yet there's all sorts of things you can argue about the Spiva report, right? But over the last 15 years, the percentage of large cap funds that beat the S&P 500 was sub 13%, I
Yeah.
believe. So you're talking about, if you're an allocator, to pick those active managers that were able to outperform that hot tech hand required 15 years ago figuring out who those funds were going to be and then allocating to them and then sticking with them. And right. And I think our presumption is if they outperformed over 15 years, like, your mind naturally goes to, it must have been smooth. I bet if you dove into those funds, it's like there was 1 year that they had a
I
lot of
did that, right?
outperformance.
So what I did is just I went to Y charts and pulled. It's their database, so it's not as wide as Viva's and doesn't have survivorship bias. It was just a simple analysis. I pulled all the 20-year performance of every single large cap US fund, and I think it was like 3,200. How many of them outperformed the S&P? This was shocking to me. I actually reached out to their team to say, this can't be like, this can't. He's like, no, we see it too. 41 funds out of 3,200 that outperformed the S&P. And the most important part for me was, let's assume that those 41 will continue to outperform for the next 20 years. Even if we have that assumption, the next question was, what do investors and advisors care about most years? And they care about saying either to themselves as individual investors or to their clients as advisors, we beat the S&P 500 this year. We beat our index this year. How often are you doing that? And there were 21 observations because I did 1994 to 2024. Out of 21 observations, the median outperformance of those 41 funds was 11 out of 21 years. So half the time you're saying you did it, half the time you're saying you're not. The worst were 6 out of 21 years. So there's a handful of managers that just probably had a handful of great years, and the rest of the time it's horrendous. And you're saying, I'm sure they're going to get another great year like they did in 2017 or whatever. And then the best was only 13 out of 21. So it's not like there was one outlier that outperformed the S&P all of the time. So it's not only tough to pick, even if you do pick and you get it right, if you are a god and have perfect foresight, you're not going to get the consistency that everybody wants. And This is the holy grail of investing in beating the S&P 500, doing it consistently. And also the other thing that I found that was crazy was that the median outperformance was 0.3%, which again, I thought that was crazy.
Which all raises the question to me. I know that most investors are constrained, but we go back to this, like, why do people keep trying to fish in the same overfished pond? All the evidence suggests that large cap US equities in particular are pretty darn efficient. It's a very hard market to beat, especially in a public mutual fund or an ETF. Just the evidence suggests for the duration most investors are willing to allocate, it's a very hard market to beat. And so, again, to me, going back to the core question of people asking us, okay, we care less about risk management, we care more about the right tail right now. If you can unshackle your risk budget from this long only concept and just say, let me just get the beta and let me stack something else. What do we have more confidence in generating positive excess returns on a more consistent basis than stock picking? And I think there's a whole lot of things that I would rather spend my active risk budget on.
Yeah. It's the idea, Samuelson's dictum, that the markets are micro efficient, but macro inefficient. As Adam likes to say over and over again, 99.99, I think you fact checked that, Adam. 99.99% of the computational brain power of investors goes into picking better stocks than everybody else.
Yep.
And nobody really focuses on the structural macro alpha that you could take advantage of. And really, in the piece that I wrote, Return Stacking, a different way to outperform the benchmarks, we make a case for that structural or alternative beta on top so that you can have this ability to outperform without necessarily stacking more risk. In fact, what we show is that the peak to trough losses are lower. And the return in this particular case, where we stacked 25% trend and 25% carries, used the DSAM carry index, was 3.2% outperformance with lower drawdowns and 18 out of 21 years of more consistently saying, yeah, with my $100, I was able to beat the S&P 18 out of 21 years.
Yeah.
Right. So again, it comes down
And
to
I
the
think
basic. I got X amount of money. I want to do something. If you care about beating the index, you can try as hard as you can competing for that money against other stock pickers, or you can simply just think about macro inefficiencies and use that to your advantage. And I don't think anybody's using that.
Well, and I think the other thing is the emotional tracking error challenges that come with approaches that have many years, whilst they might outperform the S&P, they have many years of underperformance. So the classic one was Warren Buffett through the 1990 to 2001, 2, 3. Obviously, Warren Buffett, a very astute investor, but underperformed the S&P by an astounding amount, was behind by about 50% at the peak of the 2000 market.
Yeah.
And so how many people were able to weather that storm of that massive of a tracking error in order to stick to the plan of the Warren Buffett hood? And this is where I think, Corey, you always coin this, like the behavioral aspect and the stick to itness, the ability to actually do the thing that's required is a big part of it. And emotionally being able to celebrate with your friends while they're celebrating, and then suffer a little bit, but maybe suffer a little bit less than your friends when they're suffering. There's a lot of humanity in that. And just as an aside, just thinking about that, the tracking error, I pulled up RAFI, and we talk about an index that is more fundamentally weighted. It's a pretty big difference from the cap weighted index.
Right.
So if you're going to fundamentally weight, NVIDIA, not in your top 10 for RAFI. You have half weight in Microsoft, half weight in Apple, significantly reduced weight in Alphabet. Biggest bets are Intel, Berkshire, Citi, Bank of America, and JP Morgan on the upside bet. And then the underweightings are Microsoft, NVIDIA, Apple, Amazon, and Tesla. You can imagine that's as of end of December 2023. So you can imagine the tracking error that this is inflicting on people to be weighted in a fundamental way. Or I go back to my example of Warren Buffett in the 2000s where he had lost his touch. Those are emotionally trying issues. And then as an advisor, you always have to think of what is the tracking error? The tracking error for someone in Texas is different from the tracking error for someone in Silicon Valley, potentially.
Right.
The advisor has to be aware of those intricacies on the personal situation of the investor.
Not only that, I think what's interesting is those managers, when I was just listening to a podcast from the guy from Greenlight Capital, Einhorn, and a couple other well-known names, these are managers that outperform because they concentrate in 9 to 12 positions and their tracking error is insane. Their volatility is twice as much as the markets. But they perform. Like Warren Buffett, I think we know from the work that AQR has done that I think it's 1.6% levered quality. Am I right? So
Quality
1.6
he's stacking and
times
it shows, and
levered,
he's
yeah.
stacking in one risk, right? So it does show with the volatility and the drawdown.
Here's the thing too. His portfolio is a portfolio of securities, which is a set of securities that funds insurance. And there's a very low correlation between investment returns and insurance claims.
Right.
And so there's a number of layers, not just his investment portfolio. It's how the investment portfolio is funded, how they underwrite insurance. They don't write it when it's cheap. They only write it when they can make money on it. They take a bow and don't write as much as and so they have this constant cash flow. They have payouts on the other side that are not correlated to anything because they're related to natural disasters, insurance claims. So there's a myriad of things in the stack that Warren Buffett does that are magic that just can't be achieved by the individual investor, not to mention the permanent capital, not having to mention the ins and outs.
I would argue Warren Buffett would have been out of business a number of times if he was running a public fund.
Agreed.
Right? He just would have run out of capital. It's just how
the 2000s are a classic example of that. He would have been like Oakmart and Howard Marks's firm, or Oak Tree. Right. And GMO, they suffered mightily in that period of 2000. I think GMO in particular was quite close to,
so was AQR.
I don't know if they were closing the doors, but they were low on AUM.
If I can, a consistent theme in my career is stealing from Cliff Asness. So I'll steal a quote from Cliff or paraphrase him, which was, he talked about the difference between behavioral time and statistical time. And us as asset managers in our ivory tower, we always look at things and say, look, yeah, absolutely. Something with a 0.3 Sharp can be underwater for a decade. And so we see it on a back test, or even when we live it in real life, if we can be objective, we're like, well, that's just life. That is the risk adjusted return of this asset class. And we realized the risk and the return wasn't there, but that's why the expectation of return is there. You can't always go up. But in behavioral time, right? That's like dog years. That's okay. You underperform for 3 years. We might as well have underperformed for 20. And so you just get this time dilation effect between people who are designing strategies versus the people who are investing. And so again, I go back to Rod, your piece talking about managed futures and carry as an overlay and the macro inefficiencies that you might be able to take advantage of by investing in global futures, commodities, currencies, rates, bonds, and equities. I wrote a similar piece and I just said, look, even if you don't implement these strategies yourselves, like there are diversified alternative funds out there that you can get access to global style premia, systematic macro, trend following, reinsurance, cap bonds, diversified arbitrage, Bitcoin, all packaged together. And if you can stack that diversified package of alternatives, do you think that diversified package of alternatives has a higher likelihood of having a positive excess return on a more consistent basis than value investing? Even a diversified set of active factors. Again, I think the evidence suggests that even if you just stick to the stuff that you think is a risk premium, like just pure merger arbitrage and that sort of stuff, I still think the evidence is more in the favor of stacking the alternatives than in stock picking.
Yeah, and that piece is excess returns through a structural edge. And the way you picked some of the older ones, right?
Yeah, I picked the 3 funds that came to mind. So it was just pure survivorship bias. Let's be honest here. I think I picked AQR and Stone Ridge and FS, who all have multi-strategy funds. And I'm sure there are others that have gone out of business for bad performance. The point wasn't go buy those funds by any means. The point was,
what funds were those, Corey?
It was the AQR
diversified strategy.
I see what you're doing. You almost got me. But the point just being, by buying those 3 funds, they gave access to a huge breadth of alternative strategies, right? You were diversifying your diversifiers. Yeah. And do you think that breadth of alternatives, even after fees and taxes, has a higher likelihood of creating outperformance, positive excess returns versus active stock picking. And it's hard for me to not say yes to that question.
The issue, of course, is that those funds at any given time of the last 3 years, independently or together, would have been fired. You would have been fired if you just had them, if you just owned them as your thing compared to the S&P, right? But it is the idea of doing whatever it is, like as much macro, non-efficient areas that you can stack your portfolio with. I think something, again, to shine the light on. And that piece does it really well. Why don't
The
we?
other thing that, just really quickly, the other thing that I think that gets overlooked here a lot is, and most advisors I talk to, if I ask them what their active risk budget was, they probably wouldn't have an answer. I don't think most advisors talk about active risk budgets, but they have an intuition for how off the S&P they want to be, right? And it's normally like they want to be plus or minus 5%. They never want to be that much off. And that can be difficult when you're talking about combining a bunch of active managers, right? You pick 5 or 6 active stock pickers. You need to understand their style drift potential. You need to understand their different styles, how and when they might overlap, how much active risk those managers are taking and how that all comes together. Versus if you take a stacking approach, right? Basically, the vol of your stack times the size of your stack is basically your active risk, right? And so you can size that stack up and down for how much risk you want to take versus the S&P, right? You create a diversified set of alternatives that have a vol of 10, and you give it a 10% allocation, 10% stack. Great, your active risk is 1%. You're going to be in 99% of years plus or minus 3% of the S&P 500.
Okay, so let's
I'm
talk
going to
about that.
enforce this drinking game.
Yeah,
Honestly.
okay. No, that's fine. You can
We
do
need to get stacked.
It's called the Return Stacking Podcast. Get over it. So
Give me another
that's a
name, Adam.
metric.
Overlay?
That's a metric, Corey, that you've thrown out before, and I think it's a decent heuristic, but it's not necessarily true depending on how correlated assets are, right? You're not just
No,
stacking 10%. If you're putting a 10%
I'm
out,
saying if the stack has a 10% vol. If
right?
you look at the overlay as a whole,
hmm
yeah, I agree. If it's multiple things that are 10%, that math doesn't work. You need to look at their vol in combination as a portfolio.
Right. So okay, it might be lower, is what I'm saying.
Yes.
Now,
Yep. Yeah.
it's a good
Yeah.
heuristic,
If you
but
do
it's not
10%
necessarily
managed,
true.
if you do 10% managed futures plus 10% carry, you're probably getting a sub 10% volatility combination.
Exactly. Now, we've been focusing on the S&P and trying to yes and that the problem of FOMO right now, but I think this is precisely the moment that I think we need to be talking about all weather and all terrain too. And this is a time when nobody wants to talk about it. I know, Mike, that your intuition tells you that this can probably go on much longer than we think. My intuition says the other way, and generally is that way, but I've been wrong for a while now. One of the things that I think we should talk about is that we finally spent some time and put together some new model portfolios behind the website that really deal with all-terrain investing. So we can't really talk about it or show anything because it is behind that. It's only for sophisticated investors, but for those advisors that are interested in seeing how we've thought about the all-weather problem and the way we think about it in all-weather and all-terrain is we think about it in different risk metrics, right? Less about what percentage stack, but rather you want to, in an all-weather portfolio, all-terrain portfolio at 6% volatility target, at 9% target, at 12% target, at 15% target, depending on where you are in your life, in your glide path. We put that together. And so if you happen to be an advisor or anybody that is sophisticated enough to get access to it, go to the website, ask for access, and the information is there. And hopefully we can help do this before the storm rather than
And
after.
it's a balancing act between optimality from the standpoint of an investment framework and not knowing the future. So diversifying and being balanced across your risks versus what kind of tracking error can you sustain over what kind of time periods. And this is where you need the professional advice of an advisor often to help you understand that. Corey, your heuristic is a good one. How do you help advisors think through that? And that's what the model portfolios do. They help you look at that and get some intuition as to how much tracking you might be able to withstand because it's not 0 or 1. You don't have to go to full optimality. There's a hybrid where you can say, I need to track this much and I need to look like the S&P 30% of the time or 50% of the time. So you need to think through that. And those model portfolios, I think, can be very helpful in providing intuition and insight around that as an advisor or allocator.
It'd be helpful to go through some of the mechanical thinking that went into the development of those
Yeah.
portfolios.
Adam, why don't you go?
Maybe we can go back to nothing new under the sun, right? We have long embraced the general framework proposed by guys like Harry Brown with his permanent portfolio and Ray, what's his name from Bridgewater?
Frank Dalio. I'm like,
Yeah,
you can't mean Dalio.
I know. Yeah.
But I hope you saw his Instagram post today where he looked like he was high on Molly at a Taylor Swift concert.
I did, and I can't wait to go see.
Yeah, he was saying Taylor Swift for president. He was at the Singapore concert. Anyway,
Man.
moving on.
I don't know where I pick up off that comment, but
Well, tell me where that fits in his regime framework.
Yeah.
Anyway, so back when he was focused on investing, I guess, he espoused or wrote about this concept of all-weather investing. And we had a good chat actually with a couple of Bridgewater alumni, Bob, Elliot. And Constant over the weekend. And there's a number of different kind of takes on this. And some people have called this kind of global risk parity. And that typically is built a little bit differently, but with the same objectives. And the all-weather concept is designed to be a portfolio where you've thought about what each of the sensitivity of each of the assets that you hold in that portfolio to changes in expectations around inflation and growth, right? So you've got some markets, either because they're long duration assets or because they're particularly mechanically connected to a certain dynamic in markets, are more likely to have a very large shift in their price in the event of a meaningful shift in expectations about inflation or growth. Others, think about copper or crude oil or very long-term treasury strips. And then you've got other assets that typically have a more muted reaction, but still predictable in a certain direction, right? When inflation ticks a little higher than expected, we expect short-term rates to rise in anticipation of a greater probability that the Fed is going to intervene and maybe raise rates at some point in the future. But that doesn't really have a huge impact on price because it's such a short duration asset, right? So we like to think about diversification from an all-weather context as being a combination of diversity and balance, where diversity is holding assets in the portfolio that will mechanically be expected to respond in very different ways for different reasons to changes in growth and inflation expectations, but also account for the fact that different kinds of markets will react with different magnitudes to those changes, right? Two-year treasuries are going to react in very different magnitudes than long-term strips. Both of them likely to react in somewhat the same direction, but you want to make sure that the risk of each of those assets is held relatively in balance in the portfolio, right? So that's the idea of risk parity. It's diversity and balance. And that's what we try to do with all weather, but we try to take more of a Bridgewater approach where we analyze the different inflation and growth scenarios and the types of inflation scenarios, and then went back and looked at history to determine just what direction on average, and on average, how much the different constituents of the portfolio reacted in each of those shifts.
And I think we're calling it all terrain because we're adding the extra level of how does trend react in those regimes, right? Much like when you think about equities, commodities, bonds, we get a figure, a feel for what they do at different times. And commodities clearly will do well in a demand pull inflation scenario. You're going to have treasuries do well when there's a non-inflationary bear market, and equities do well in growth environment. Trend following seems to have a hybrid in terms of its maximum movements tend to hover around periods where trends are really clear. Oftentimes that happens during bear markets. Sometimes it happens during massive bull markets too, right? When there's a right tail kind of clear trend happening in a handful of markets. But it also, so it has this hybrid benefit of doing really well during bear markets, but also tends to do relatively well in inflation regimes. So it straddles the world of treasuries and commodities. It has a unique place in that framework that ultimately led to allocations across our model portfolios.
I think in general, the idea is that you want to expand the idea of all weather to the greatest extent possible by adding as many sleeves that are going to behave differently. Some sleeves are agnostic to inflation and growth.
Right.
Other sleeves have very predictable responses to them. But the idea is to just get general diversity. You've got a lot of uncorrelated bets in the portfolio, typically more the merrier.
Adam, how do you think about, and this is a conversation you put out on Twitter over the weekend, and you didn't get many bites. And I said, I'm going to respond just to try to get some conversation going. And then it seemed like a lot of conversation did get going around this, which was great. But I made the point, and just for the sake of argument, I was saying, to back up a sec, you had highlighted an interview that Bob Elliott had done with the gentleman over at Excess Returns about how he invests. And he
Yep.
took a similar all weather approach and then added things like trend and diversified alpha as active diversifying components in combination with his risk parity. And you said, why would you not do this? And my rebuttal back was, confidence adjusted, I have a stronger view in stocks and bonds maintaining a positive risk premium over the long run than I might have in something like trend or carry or a systematic macro strategy that is inherently generating its P&L not from a risk premium. Now, maybe trend and carry actually are risk premium. That's a totally different point. But I want to get your thoughts is in thinking about designing an all-terrain strategy, like how do you think about confidence adjusting your view that trend will actually respond the way you expect it to versus commodities? There's almost like a true mechanical reason why they're going to respond a certain way in the regime, because almost by definition, the regime is that regime because of the prices change, right? Like you can't have an inflationary regime where prices don't change. My
But
question is, how do you think about designing an all-terrain strategy where maybe you have a lot more confidence in that delta component of something like commodities than over the next 20 years? Are you confident that trend is going to respond in an inflationary regime the same way it did in the 70s and 80s?
yeah, I don't think we're making a strong case that you want to own trend to protect against an inflationary regime only. I think the case is that you own trend because it provides time varying exposure to different broad asset class categories. And look, we can have a variety of different explanations for trend. One of them might be related to the fact that typically when market expectations change, they don't change overnight, right? It took a long time for the market to come around to the fact we were going to have a sustained inflationary shock after the first larger than anticipated CPI print. We had to have a lot of larger than expected CPI prints in concert with some fundamental narratives around the war in Ukraine, et cetera, in order to allow that narrative to shift. And it's that meandering shift in narrative and investors in a staggered way as different investors come to believe there's a shift and develop confidence in that shift at different times, there's a shift in allocation. And those flows then drive divergences in prices that trend following managers take advantage of. One might argue that trend following is mechanically designed to, especially intermediate to long-term trend following, is mechanically designed to profit from these kind of diffusion of shifts in expectations about inflation and growth. So where you've got a passive all weather, not taking a position, just equally anticipating inflation and growth regimes at all times. Trend is a nice little overlay that takes advantage of changes in expectations that go on between those different regimes and help to offset the fact that if diversification means always having to say you're sorry or always having regret, obviously you can't be in all four regimes at once. So there's always going to be at least one asset class that is disappointing you and other asset classes that you might have allocated more to that are doing better than you'd hoped or expected. and that causes regret, right? So you could imagine a scenario where adding trend helps to alleviate some of that regret, because as investor expectations are changing, we're reducing exposure to the regimes that investors are abandoning and experiencing some of that appreciation in prices where investors are reallocating their capital to.
And
Shout out to Brian Portnoy for coining the phrase diversification always means saying you're sorry.
yeah. And I think one of the when I've been looking at risk parity, and I've been analogizing it to a motor with three pistons, where you have equities for bull markets, uh, sovereign bonds for non-inflationary bear markets, and commodities for inflationary regimes. What you find over the years is that almost every year, two out of the three pistons are going up. And that's what creates the stability of returns that you see over time in risk parity. But there are moments where two pistons are down and one is up. And what will happen is if you're equal risk across those three, you will have risk parity suffer. I think the concept of this trend following component that straddles both bear markets and inflation regimes gives that fourth piston that will give it a fighting chance to not lose, or maybe even make a little bit of money, because it has that two going up, two going down. And if we look at 2008, for example, out of those three pistons, you had equities down, commodities down, and treasuries up. That still hurt risk parity in equal risk. If you add a fourth component, trend, you at least have a fighting chance of not losing. In 2022, you had commodities up and equities and bonds down. By adding that trend component, and we know this empirically, you had a good chance of at least not losing. And so there are examples of this. And then sometimes it's all of them go down together. So the COVID, in the beginning, you saw treasuries go up, equities and commodities go down. But then the liquidity crunch hit, where everything just went down together. And the only way you can have even a shot at it is if you're lucky enough where trend happened to be short the right things to make some money during those moments of maximum pain. So I think the risk parity concept is good. The fact that you can count on the risk premium of equities and bonds, great. If you can lever enough to add commodities in there, which, there's still the argument whether commodities have a positive risk premium or not. But if you're stacking it on top and the real return is zero, it's a zero cost hedge for inflation, not bad, right? And then you add that trend component, that's the magic. And of course, what I always have to think about is, do we have the same type of clarity for other risk premiums out there?
I was just going to say, Rodrigo, if you like the steak knives and you like the cutting board and the free shipping, have I got a deal for you? I'm wondering if Adam can shed some light on how carry complements risk parity and how it covers off sort of the blind spot that is a very sort of somewhat obvious one in risk parity, and does such a wonderful job for it. You might get two sets of knives, a cutting board, and free shipping here.
Have you ever tried the Cutco scissors? Those are really good. The knives and the scissors.
The knives and the scissors.
You can cut them.
Those of you at home, try not to cut yourselves. Okay.
Disclosure.
You're leaking a little bit of alpha here.
You're right. So let's take that offer off the table.
I think it's nice that we can set the table a little bit for risk parity, right? Risk parity assumes that there's always a positive term premium in bonds. There's always a positive risk premium in equities. There's always a backwardated term structure in commodities. And the fact is, that's just not always true. We just lived through a really salient example of where that was proven to be fallacious, right? You've got I think the yield curve is still pretty darn inverted, and it has been since 2022. There haven't been a lot of examples of an inverted yield curve over the past 40 years. The yield curve spent quite a lot of time during the 70s inverted, but we just haven't had a lot of example. Typically, bonds do have a positive term structure, right? So you expect higher returns by locking your money up in bonds further out than you expect to get if you have a chance of getting your money back at par in a few months' time. And you expect a higher return on equities than you would get on cash. But interestingly, at the moment, you can get about 4.5% or pretty close to it on cash-like instruments, and the yield on the S&P 500 is sub 2%, right? Commodities, in theory, most of them are always in backwardation, which means that you're earning a positive carry on holding a basket of commodity futures. But in reality, they're not in backwardation all the time. Oftentimes, for demand dynamics or seasonality dynamics or what have you, they flip between backwardation and contango. My point is, risk parity assumes that there's always a positive risk premium across all of the assets that you hold. But in reality, that's not always true. And what carry does is it says, I want diversity and I want balance, but I'm not going to assume that all of the markets have positive excess returns all the time. And where the yield curve is inverted or the commodity term structure is inverted, then I'm actually going to hold more short-term bonds against long-term bonds, or I'm going to hold some commodities short, or I'm going to hold some markets with a higher yield, some equity markets with a higher yield with larger weights, and hold some equity markets with a very low real yield short. And it turns out that if you apply kind of risk parity principles, but you're always aligned in the direction of the expected risk premium, that historically that's just generated a lot more, well, a stronger and a lot more comfortable and smooth return trajectory.
And so the assumption in risk parity is that there is a positive risk premium across the things that you invest in at all times, right?
Always and everywhere. Yep.
Because it is one of those concepts that is about preparation, not prediction. You don't know the future. Broadly speaking, if you were to close your eyes, put something to work, and then wake up 20 years from now, that should still stand, right? Being an
I
inverted
think you
yield
can make
curve,
an efficient markets argument about that too, right? Which
right?
is, broadly speaking, for risk assets, if they didn't have a positive expected return, the price is wrong. The only case that's not true is if they offer a tremendous diversification benefit, right?
Yeah. And
Yeah, no,
so
that's a really good point. That's the theoretical justification for a global risk parity or all weather portfolio, right? And most of the time it holds true empirically as well, right? It's not so common, or it's not an all the time or most of the time type thing in commodities. It's a lot of times when commodity term structure flips around and you would vastly prefer to be short than long. But when the term structure does flip, it historically has been really profitable to take advantage of that.
it's the difference, I think, between a risk parity concept. Again, it's about set, forget. I just had to write in my will what I want my money to do when I die. One of the key things was, what can I count on for people not to screw up, where I don't need somebody managing it day to day, and I want just to set it and forget it. No, a risk parity concept for a 20-year portfolio, 100-year portfolio is good with me. But if you have the opportunity to be more thoughtful about kind of the nuance, like, you think about the assumptions that risk parity makes, they're very long-term assumptions. The assumptions that Gary makes is, look, there are periods where we can clearly observe that it's a bad idea to be long these things compared to cash or whatever the case. Is finding a strong carry component in all these asset classes predictive that it's going to continue to provide different positive returns in the future? And we find many papers have found that it is. And so it is an active way, and it's very diversified because you're using as many assets as you can, and you're weighting them in a risk parity component. But the weighting then, you have the ability to short, and the weighting is defined by carry and risk rather than expected risk premia and risk and long only, right? So you're removing that short component. You're having a slightly separate assumption. And it turns out that it has this characteristic of doing pretty well most years, like risk parity does. And then when things really go poorly, especially if it's adjusted slowly, a lot of people have this hang up that carry gets crushed in bear markets, right? But because I think a lot of people relate the word carry to the yen US dollar carry, which tends to be true,
Or vol carry.
or vol carry. But when you're doing a diversified risk parity style carry, where it turns out that most of the time it gets out of the way, at the very least doesn't lose too much money, and sometimes it actually makes positive returns during periods of prolonged bear markets, right?
On average, historically, global carry has had positive returns during the worst quarters for equities and during the worst equity sustained bear markets.
And
There's
mechanically, it
just
makes sense.
there's just no relationship.
Mechanically, it makes sense, but it's also not as good empirically as trend in protecting those big abrupt gaps that you see in equity markets, because trend is just
Trend is
focused on one.
structurally designed to be more responsive during those higher volatility tail events.
Yeah.
Smile.
It's just for me, when I look at if you're thinking about adding on different stacks or different alternatives, to me, the next best thing is carry, because it also empirically has shown very low correlation to trends. So what are you looking for here? You're looking for low correlation. Equity and bonds have low correlation. Equity bonds trend have low correlation. Equity bonds trends and carry have low correlation and cross correlation with each other, which is fantastic. And it's really approachable, rather than trying to find alpha managers that can't tell you what they're doing, because once the secret's out, you can't sustain it, right?
Rod, that comment you made about your will, I've also thought a lot about in the last year, given that parenthood came upon me, and thinking about, I actually had to put together a will, and it's just something that I'd never done and all that sort of stuff. And I was thinking about the scattered nature of my investments, and that if I died, my wife would kill me. And a huge part for me of the return stacked mission was launching these products such that I could basically get 99% of the way of my perfect portfolio in 3 or 5 products and combine them, and just say to my wife,
Do that.
or not even my wife, maybe just leave them. But if I
If
die,
I'm dead, don't kill me.
yeah, exactly.
The best compliment
Uh,
that I've gotten, because I was in a Spanish podcast the other week, and I mentioned that I was going on a trip and my wife wanted me to fill in all the things, including the portfolio. And I told him what I decided to do. And he was inspired by that and came back to me and said, just so you know, what you've created, what you've pushed out, that's 100% of what my wife is going to do when we die. I've made it explicit now. And I think it speaks to the ability to get access to that easily and with enough education that it makes sense, right?
by the way, Mike, I know you're laughing at the fact that I said my wife would kill me if I died, but you've met my wife. She would
No,
find a
Yeah,
way
no,
to bring me
that's what
back
makes it so funny.
just to kill me.
Yeah. To re-kill you. And by the way,
Yeah.
Corey,
She might kill some of
will
us. She
be-
might come
I will
after some of
take
your
care of the
friends
family.
just to.
just so you know,
Oh, thank
I'm a
you.
yes.
I
I'll
appreciate
take care
that
of the
offer.
kids.
I just want to go on the
I'm going
record
to take
that
care of your wife. So he can have the kid. I'll take care of Lord. It's fine. I'm a giver.
I just want to go on the record as to want my lifetime stack to be just trend and carry. And the fucking stocks and bonds can get stuffed.
Jesus. That overconfidence coming out, Mr. Butler. Every
I
time.
What do you
don't know.
mean?
I think that stocks and bonds are massively overowned. That if anything's got overconfidence, it's the confidence in equities and bonds, and that there's just very little attention being paid to these alternatives.
I think the difference, Adam, is I'm talking about multi-generational wealth here. I'm talking about hundreds of years, right?
Right.
That's and hence I
Fortune.
want
You
long-term
gotta-
equity exposure.
Your lineage requires
That's right. I got to think about
simplicity. So one of the things I want to talk about is the glide path reimagined pieces, Corey. And I don't know
Yeah.
if you want to get into that a little bit, because I thought I've been dying to write about that for years and never got around to it. And I'm glad you finally did. Do you want to walk us through that? Maybe part 1 or part 2? Or
That's what Stephen Braun on my team wrote these. There's a rebuild of some articles we wrote, I think in 2017. And the idea here was to say glide paths are a wonderful invention for most people who are not going to think deeply about investments. But the reality is, not every 50-year-old is in the same financial situation. So, is there a way in which we can try to generalize the problem a little bit more and try to find what would be the optimal portfolio for someone of a certain age and of a certain wealth level? Now, optimal here can take so many different definitions. We just defined optimal as being maximizing the probability of not running out of money before you die. And then we said, instead of saying how old someone was, we were just going to try to measure years from death, right? Because you could be a very healthy 90-year-old and have a higher life living expectation than a very unhealthy 60-year-old, right? So we really wanted to generalize the framework as much as possible. But the idea was, if you died with a penny to your name, that was considered success. There was no, benefit for excess bequeathment. And then, starting with that assumption, we walked backwards and took a step backwards and said, every year you're going to spend one wealth unit, and we're going to have to figure out for given how many wealth units you have, what portfolio should you invest in such that you then don't run out of money over that next step. And you keep walking that process backwards. And this really interesting sort of zone region emerges in this grid. And if you look at it, there's really three primary zones. One is this top right triangle that says you have enough money that you're just not going to run out. Just don't mess up. You could invest in cash. You could invest in a diversified portfolio. As long as you're not spending all your money on lottery tickets every year, like you have so much more money than you're planning on spending. It's a do anything zone. And we said, we're just going to put that in the most conservative portfolio possible. That's all in short-term T-bills. But really, there's a lot of flexibility to what people can do. You then get into the second zone that says, all right, this is where there's more of a gradient that says, okay, you don't have enough to do whatever you want. You need some growth, but you can't necessarily go all growth because then you take too much risk, too much drawdown risk. And if you get too big a drawdown, then that amount you plan on spending in retirement represents too large a portion, and then you can outspend whatever you have left. And so you find these portfolios of varying diversification between stocks, bonds, cash, and trend following. The final zone was at the very bottom, which said you do not have enough money. You are going to run out of money guaranteed. You better swing for the fences. And that's where you saw risk dialed up. And so the first article did this without any stacking. And what you saw was at the very bottom, you were all in at equities because you had to really crank up the risk. And that top right triangle, you were all cash. And in the middle, it was a mix between stocks, bonds, and managed futures, trend following, depending upon how safe you were. The safer you were, it was more bonds and cash. Towards the bottom, the more growth you needed, it was a mix between stocks and managed futures. What was interesting is when we got to adding stacking, and that was the second article, and said, what if we allow this to go up to a stack of 200%? What would you end up doing? And what was interesting is the optimizer almost never recommended a stack of 200%, except in that case where you were guaranteed to run out of money. And that's just pure lottery ticket. But in those diversified portfolios, it was mostly recommending a stack between 10 of 20%. And it was a very diversified portfolio of stocks, bonds, and trend following. And it increased the likelihood of success compared to not stacking by, I think, 30 or 40%.
Amazing.
And so you saw this, and what you saw emerge effectively was through the use of stacking, aka leverage, you were able to benefit from diversification and have a greater certainty that you were going to meet your desired outcomes in retirement. Now, again, all caveated around this is all simulation based. We have one very simple definition of success, but I think the framework holds intuitively that, again, more diversification is typically better when it comes to having greater certainty in your outcomes.
As long as you can extract those rents from the asset classes that you would otherwise need to go 100% on to get lucky, right? Especially if you're getting into that space where you don't have enough, you have to go 100% equity. Okay, what if you can go 100% equity and 50% something else, right? That's
Well, tell you what, here's really fascinating. You're talking about that 100% equity plus 50% something else. When you talk about stacking and the lottery tickets, you ended up not having as much equity. That portion where you really need to outgrow, you ended up doing a ton of trend following. Because trend following has historically had much more asymmetry in the returns. It had years where upside was similar to equity, but it never had downside years that were similar to equity.
Right.
And so it was able to apply more leverage to trend following to try to get that asymmetric positive payoff versus loading all up on equities and risking running into a 2008.
Right.
Yep. I hear you. No need for equities. Loud and clear.
What that is the takeaway.
That's a takeaway. Yeah. This is not investment advice from Adam Butler. Yeah. I think
Just
that's,
preferences.
and it's what's interesting about all this is I was speaking to a planner today that had started going down the rabbit hole in the content. He's like, I cannot believe I've never heard of this in my career. I don't understand. It seems like it's magic. And what I told him is that you weren't talking about it because it wasn't available to you. You couldn't do it. So what's the point, right? It's like doctors. I was listening to Dr. Peter Attia, and it was talking about how when they would decide to do certain tests or not, and there are certain tests that they simply will not do, even though it'll tell you that something bad will happen to you because there's nothing they can do. So the ethical thing to do is to not run the test because there's no intervention that will make their life better. And that's what I told him. Like there was no intervention that would make your life as a financial planner better until recently. And so what does that mean? It means that we're just waking up to all of this. Again, going back to Peter Attia, what he talked about is that what's happening is that even though guidelines have changed for a lot of things, it's only the younger doctors that are up to speed and reading and motivated to do better for their clients than the older doctors that are set in their ways, are not going to those conferences and learning about it and changing their practice. That's going to be really hard. That it's going to be the next generation that is going to have the motivation tools and access to be able to apply these new technologies, right? So I feel like there's an opportunity for everybody here in the space to do better, understand how glide path reimagined works, understand how you can actually have your cake and eat it too, and provide that absolute or attempt to provide that absolute return without and adding diversification without sacrificing your core stocks and bonds and all that fun stuff. But it's going to take a lot of years and Herculean effort for us to continue to educate and everybody else to continue around us that is talking about these concepts.
Mike,
It's interesting.
do you remember growing up and traveling and you had these big suitcases and you had to carry them around
Yeah.
like with a handle?
Yeah,
Right?
there was no wheels.
Did you know that wheels on suitcases didn't come out till 1987?
Yeah. Oh, yeah, I've heard that
1987.
story.
Like, I remember traveling as a
I'm sorry,
child
what?
and carrying
Yeah.
the bags around. Before that
When was
time,
Google
there were,
invented again?
Oh,
yeah,
that's how long it
exactly.
took.
Exactly. This is what I need. Yeah. I talk to everybody and they hear about this and they're like, no, this can't be like that. I'm just hearing about this now. It
Yeah.
can't be that you guys did. This is the first time anybody's ever done this. I'm like, wheels on suitcases, 1987, right? But it just, for some reason, it takes a long time for us humans to figure out why we can't, what these dead obvious solutions are. But of course, now you wouldn't be caught dead unless you had a backpack. You wouldn't be caught dead traveling without wheels on your luggage. Honestly, I don't know why any portfolio wouldn't have a good slug of these return stack strategies, because it literally is having your diversification and giving up nothing.
But a lot of it has to do for structural reasons too, right? Like it's the machine that feeds the advisors that are the gatekeepers to doing all of this. And I'm going to go back to medicine because I also want to do a public service announcement for anybody here who's listening, something that I've gone down the rabbit hole recently on. And it's all the cardiovascular risk that we hear about has revolved around the bad cholesterol, right? The LDL-C. And that level is high, you got to measure it. But 20 years ago, science discovered that in fact, there's this one particular reading, the LP little a particle, that is the most correlated to heart disease of any of the metrics. It has taken 20 years for that to filter up to the boards that make decisions whether they're going to change the guidelines. As far as this is just from a podcast, I don't know for sure, but as far as I can tell, Canada is the only one that's implemented this and actually put in their guidelines that we need to start looking for LP little a, even though the lead lipidologists know about this, right? We still have to get through the US. We got to do the UK. We got to every country is going to take their sweet time to do this. 20 years ago, we know this to be true from all this. Every lipidologist you talk to, they know they're going to do that, but the average MD does not know and is not required to know it. So it's not just the individuals at the top. It's the machine that says, leverage is bad. There's no way we're going to allow you to do, even though we know from the Nobel Prize winning concept of the efficient frontier and the capital market line that we've known this since the 50s, that it is a sound approach to investing. So, by the way, if you haven't had your LP little a tested, get your LP little a tested. You need to take aggressive measures in order to fix it.
I think Rodrigo may have left some of you feeling like he just listened to a podcast and how he's an expert in lipids. But this is like years of investigating this. So you said, I don't know. I just listened to a podcast, but this is what I understand now.
And
So
the podcast that I meant is I didn't know how many countries had applied it in their mandates yet. But yes, as Adam alludes to, this is my second passion. So anyway, that's the one thing.
Lipidology.
Tell us
Are
why.
very common second passion.
Yeah, lipidology.
And if you do have a high LP little a, get your will straight. Just kidding. You can do lots about it. There's drugs coming down the pike. But it is a good analogy. Like, this is how long it takes. So the good news is that if you are willing and able to adapt to it right now, you have all the tools available to fix it. So, and also if you're an advisor, there's a lot of alpha there. I just keep telling people that when I started in this business, I was a private wealth advisor back when I was in my mid 20s. I grew like gangbusters because I was telling this story and nobody else was, right? So it's just, if you can capture this magic in a bottle and talk about this concept, you'll be the only one talking about this concept right now. And my personal experience was that everybody was like, no way, I got to learn more. And it was just easy to take meetings, easy to get people on board. Because once you take that red pill, it's tough to go back. But they're not hearing from anybody else. It's something that is not only useful for the individuals that are going to receive the medicine, but also the practitioners of it in terms of their own business revenues.
You know what? It's just so easy. You know what I love? I love French fries. You know what I like more? French fries with ketchup. You know what I love? I love apple pie. You know what I like more? Apple pie and ice cream. You know what I love?
I'm glad you didn't say apple pie and American cheese.
It's a thing.
You know what I love?
I love that
Equities.
thing, by the way. I was hoping
You know what I love more? Equities and trend following. It's just so dead easy. It literally is like apple pie and ice cream or French fries and ketchup, or name 50 other things that are way better together.
And there's your clip.
So many
That's a good
things.
clip. That's going to be a great YouTube short. It's
So
going to, it's
many
what's
came
sad,
to mind that
guys,
were
is
not
that
at
one.
all acceptable.
We'll
We're
be
gonna put
adding
it on-
another video of all the other things that are better together as an appendix to this.
We're going to put this on the AI machine to pick which clips are going to go viral. And you're going to be number one. And out of all the discussions we've had today, that one is just going to go. I can guarantee you. Just to wrap it up in terms of the business benefits of this to an advisor, we did write a piece called if you're a financial advisor, you got lucky, or there's a few of them that we've done. If you go to the website and you go to practice management, there's a few key pieces that'll allow you to think through what it is to run a business, right? And what is the key risk metrics for that business. I've been telling a lot of advisors that whether you see it or not, the last 10 years of your growth has been mainly luck, right? Not to take away from the hard work and effort it takes to bring in new clients and do the right thing, but a large component of your profit has come from the fact that you've been overweight the home country bias market, bonds and equities, in one of the largest and best performing 60-40 Sharpe ratios of your career, right? You have to recognize that's happened. You got hit in 2022 and you're like, oh my God, I got lucky. I didn't even know it. I should have taken some money off the table. What do I do now? Luckily, you're right back up there, right? It's amazing what the recovery has been. It's been great.
Damn, it should have doubled down.
Should have doubled down. But the thing about these articles that we wrote under the practice management section is to address the fact that if you're a business owner that has raw materials as part of your inputs to provide a good product, you want to minimize the amount of risk that you take on that raw material. And the only business that I know that doesn't do that is the financial services industry. If you're a good manager, you're a good advisor, you have good people skills, you're good at bringing in new clients, your employees love you, you keep your costs down, you have a good margin, you should win the game based on those metrics and not on what did the S&P 500 do yesterday. And if you do an assessment of risks in your portfolio that should be minimized as much as possible, right? That if there is a bear market, when it hurts to get hurt, right? When it is a bear market, when your clients are losing money, you're losing money, and your own portfolio is losing money at the same time, everything that matters, then that is not a well-balanced business that is going to help you thrive across any scenario. You're riding the train and it's going to stop at some point. So I think this area of the website focuses on how do you make sure that your success comes from all the things that I talked about before and not just a single market, right? So please do, if you're a practitioner, take a look at those, see what you think, and let's chat about it. Would love to get more feedback on the pieces that we're writing, and we might even bring somebody on that has done it. There's a couple of people that come to mind that can talk about the same things that we just discussed here and what it's meant to their business, right? Okay, so
Peanut
I think
butter and jelly.
what's that?
Peanut butter and jelly.
Oh my-
Get stacked.
Yeah.
Working
Butler-
out and steroids.
Butler blanked out for the last 5 minutes and just came up with it. He's been thinking about it. He's got a pen. He's writing down 5 different analogies.
Oh my goodness.
Okay, I think we covered a lot of topics for this first episode. Gents, thank you so much. If anybody wants to reach us, all the information will be on the description of this video or the podcast summaries. You can always go find more information on returnstack.com. Anything else that I missed, guys? No? Everybody knows where to
No,
find
but
us.
I think we need to homogenize the lighting for next time. Corey, you look like you're in Hemingway's bar, dude. Are we gonna all be?
So
we
you
gotta
all need to dial it, warm your lights up. You get such
Fair enough.
cold, crisp lights over there.
Fair enough.
I agree.
ruined the-
I'm actually dying here from the lights. I had to turn the fan on. I'm like,
You're
getting a
looking,
tan
You're
from
looking
my light.
crisp, sharp. Don't listen to Corey. I've been bitching about the amount of shade that he gets on the right side of his face since the beginning, but I can't
Oh,
do
yeah.
anything about it. You won't do it.
I've got my rum bar right next to me. It's the vibe I'm looking for.
I love that little, what is it at the back there? Stack returns.
Stack returns.
Nice. Excellent. All right. Well, thank
Subliminal.
you.
I like that.
Thank you
Sneaky.
all for sticking by us and with us throughout this podcast. We're going to try this once a month. And if you have any questions, you want to reach out to every one of us is active on Twitter. That's probably the fastest and easiest way to reach out. If you don't have a Twitter account, then the information is on the description. Thanks again and signing off.
Hold on.
Hacking.
If we get 5,000 likes on this, Philbrick's gonna get stacked tattooed on his bicep. I can
Yes.
guarantee.
5,000 likes. Amazing. That'll happen.
Okay.
Awesome.
That's interesting.
Beautiful. Thanks all.
Thanks, everyone.
Thank you.